Okay, so very good evening to all of you. I can see Bhumika over here. So today we are going to share about concept of money supply. Last class we had discussed about money demand, and now we are going to discuss about concept of money supply. So I believe the concept of money demand is clear to all of you. Basically, money demand is of two reasons. No, we have shared. One is with respect to transactive motive, and that is the exchange, mode of exchange, and second was unit of store value. So that is about creation of wealth. So we have shared all the concepts related to money demand. Now, since money demand is there, so somebody should be there to cater money supply, isn't it? So the most important parameter is that if we want to have money, then somebody should be there to give us money. And who creates money? Money supply can be created by two. One is about RBI. In India, Reserve Bank of India takes care about printing of currency. And what is the backing of printing of currency? This is dependent on foreign exchange reserves, gold. Based on that reserve, the RBI goes for printing currency. This is known as high-powered money. High-powered money is the money which is issued by Reserve Bank of India on behalf of Government of India, and that is known as high-powered money. The second component of money can be created by banks. So the money supply in the economy can be created by two set of players. One is the Reserve Bank of India, Federal Bank of the respective countries, and second is by banks. The money which is created by Reserve Bank of India is known as high-powered money, and money which is created or which is extended, multiplied, money is multiplied by banks. That is known as credit money. So there are two supply sources of money. One is by Reserve Bank of India and second is by commercial banks, which creates credit money in the economy. So we are going to share money supply. Now, why should we share money supply? We should share money supply because of three reasons. One reason is that what governs the prices in the economy? If the prices are going up, then in that case, who's going to handle it? Like you see that US economy is going through highest inflation because of Russia and Ukraine war, energy crisis, food crisis. Even Europe is going through high price level. So when the prices goes up, then in that case, it has to be controlled. And controlling the supply of money is very difficult. So then in that case, what measures can be taken to indirectly control money supply in the economy? That is taken care by Reserve Bank of India. So for economic health of the country, money supply is very important. For controlling inflation, it is very important. For taking loans in the international market, money supply is very important. For good health of the economy, money supply is the important concept. For the financial health of the banks, money supply is a very important concept. For credit growth in the country, money supply is important. For consumption pattern of people, money supply is very important. So that is the context of money supply we are going to share today, and covering certain basic factors which governs money supply in the economy. So you can see what exactly is money supply. Money supply is the total amount of money. Total amount of money means currency deposit money. That is the money which is there in the economy with you and me in terms of currency, coins, plus the money which you keep it in the bank account. That is the demand deposits. Demand deposits are checkable deposits. You issue a check, you demand X quantum of money, which is in your bank account, and according to that, the bank honors it. So that is known as demand account. Companies, they go for opening the account in the bank, that is a current account. So they go for current account. So banks we put money, corporate put money, government puts money, all other players, non-financial companies, they put money, foreign players, they put money. So that is all the component of money supply. So money supply present in an economy at a particular point of time is a stock concept. Okay, and the standard way to measure money is usually in terms of currency in the circulation and demand deposits. Demand deposits I've already shared. What is demand deposits? Demand deposits are, you save money in the bank. Bank gives you checkbook. Through that checkbook, you demand X amount of money to pay to anybody, or to withdraw the money to spend on goods and services, or to meet your any obligations. And whatever amount you write on that, the bank is supposed to honor it depending on that much quantum of money you have in your bank account. So that is known as demand deposits. Other deposits with banks, we keep it in terms of time deposits. Time deposits are fixed deposits. So you go for putting your money in the fixed deposit in the bank, that is known as time deposits. So deposits are demand deposits and time deposits. Then the other concept is known as CASA. CASA is current account and saving account. Saving account is, we go for opening saving account, households, they go for opening a saving account because we want to save money. As we have shared according to Kins also, we save money for precautionary motive. Similarly, corporate, they go for opening the bank account, that is known as current account, where the banks do not offer any kind of interest to current account, but that makes banks liquid or makes them financially rich, isn't it? So people go for saving money in the bank, bank becomes financially rich. Once the bank becomes financially rich, they go for lending it to other. So suppose Mr. A has gone for opening the bank account and puts 1,000 rupees in the bank account. And B is a customer who comes to the bank and says that I need X amount of loan. So how the bank is going to meet loan obligations of B? Because A has put money in the bank, and that is why bank will be able to lend money to B. And since bank is lending money to B, B will go for paying it to somebody else. That's why bank is lending it to B. So B goes for paying it to C, and C goes for putting that money in the bank, in the second bank. So the second bank gets the money. And this is how the money circulates, and this is how the money multiply. This is known as credit multiplier because of the banks. So money gets multiplied in the banks. That is why this is the second component of money supply. Is it clear to all of you? So there are basically two components of money supply. One is by the central bank, which is based on the forex reserves and the gold reserves. How much gold reserves do we have and how much forex reserves we have? According to that, RBI goes for printing currency. That is based on the reserves, that how much should we print, because you know, if there is any contingency, then they should be able to pay back to the bankers, to the people, those who have deposited. And similarly, banks, they go for creating money. This is known as credit money. Credit money is created by banks by one person going for depositing money, and this generates chain of events from A to B to C to D and so and so on. And in the banks, it goes for circulating. This is how the credit money gets generated. And since from 1,000 rupees, 10,000 rupees can be generated through the credit chain. That is why it is also known as credit multiplier. So we will be sharing credit multiplier also and money multiplier also. Okay, so basic idea of money supply is clear. So change in the supply of money in economy. So during COVID, what happened during COVID? See, RBI can take care about making money easily available to you, or can make money expensive to you to get. Not only to you and me, but to the corporate also. So how RBI can make difficult or expensive money? RBI can make difficult or expensive money by going and decreasing the money supply by going for increasing the repo rate. So if RBI increases the repo rate, then in that case, the bank's borrowing cost will increase, bank borrowing. And if RBI goes for increasing the reserves ratio, which the banks have to keep. So if the reserve ratio increases, then in that case, banks will be able to lend less. And if the banks are able to lend less, then in that case, the cost of borrowings will increase, and the cost of borrowing increases means corporate will be borrowing less. So this way, the money can be expensive. The money can be easily available at a low price. During COVID, money was available at ease. So money supply idea of Reserve Bank of India, because of the government norms, was that money supply should be at ease during COVID, because people were not spending. People were hesitant to spend. People were having crisis in terms of spending money. So that's why RBI wanted to increase money supply in the economy by relaxing norms. But if inflation goes up, then in that case, RBI will prefer to decrease money supply in the economy. Okay, so change in the supply of money in the economy affects what? Affects price level. It also affects price level of securities. Securities means stock market. It makes impact on the stock market also. So for example, we say that it affects your returns on your FDs, saving deposits and others also. So how it gets affected? It reflects everywhere. You see how it reflects? It reflects on stock market in terms if the if money becomes expensive, that means the cost of borrowings will become will increase. Cost of borrowing increases means companies' margins will reduce. Companies' margin reduces means the cost won't reduce, but the prices. So the prices will go up. Prices goes up means the gap between the two will reduce and their margins will squeeze, and that will reflect on the stock market in terms of dividends. What you get through the stock market will be less. So it can be reflected on stock market. It can be reflected in terms of your deposits. It can be reflected in terms of inflation. When you see the change in the money supply, it can be due to inflation. If inflation goes up, money supply will be decreased. By whom? By Reserve Bank of India. If our currency depreciates, rupee becomes weaker and weaker and dollar becomes expensive, in that case, what will happen? RBI will go for reducing the money supply so that people demand less of dollar. People demand less of dollar. That means the gap between the demand and supply will reduce of dollar and rupee will become more stable. Business policies can be affected, or to create a conducive environment for business groups. Then in that case, RBI can go for changing the money supply in the economy. So money supply, when it can be changed based on the market scenario, based on the economic scenario, then it becomes a flow variable. But when central bank of the country says that at this point of time, on 5th of April, this is the total amount of money supply in the economy, that is a stock variable. So stock can flow, money supply can be at a point of time is a stock, and money supply which changes with the change in the macro fundamentals of the country is known as a flow variable. Okay. So we have shared that what is the significance of money supply? Money supply, it facilitates the monetary development. You can see here this about monetary development. That means banks lending, monetary developments, then corporate dividends given and other factors. So monetary development is the factor which gets affected because of the money supply. Money growth can be the factor which leads to impacting companies' growth, capital market returns, then your salary and other factors. So monetary developments can be affected because of the money supply component. Central bank all over the world adopt a monetary policy. So how RBI goes for controlling money supply? Through monetary policy. What tool do they use? They use repo rate. So repo rate is the way through which is called reserves. We will be talking about reserves. So repo rate, you know about, is about the rate at which commercial banks borrow from the Reserve Bank of India through their securities. So this is taken care. Money supply can go up, money supply can go down based on RBI's objective to bring stability in the market, to stabilize price, to enhance growth. So GDP growth rate, if they want to increase GDP growth rate, countries on the downturn during COVID we have seen. So this is how they go for controlling the supply of money. They may increase, they may decrease. This is known as high powered money taken care by Reserve Bank of India. This achieved, so this is known as monetary base. So what is the monetary base of the country? How much quantity of money RBI goes for available, making it available in the country based on its forex reserves and gold reserves in the economy. So this is known as monetary base. This is also known as high powered money. Do keep it in mind, okay? So what is minimum reserve system? Minimum reserve system is very, very important. You all know that we have shared last class also, currency issued by central bank or Reserve Bank of India is known as fiat money. Fiat money, why? Because it is not going to default. It is guaranteed by the government and it is supported by reserves by whom? by central bank. So Reserve Bank of India is having sufficient reserves on the basis of which the currency is printed, and it is guaranteed by Government of India. That is why it is known as fiat money or secured money. Okay, so the currency issued by the central bank is backed by equal value of assets, mainly consisting of gold and foreign exchange reserves. So that is why it is a fiat currency. Different countries have different parameters of minimum reserve system, that how much minimum reserve RBI should maintain and on the basis of which the currency should be issued. So 10% of the reserves, and based on that, how much we can issue. So if you go for 100% increase in printing currency, then if your minimum reserve is 10%, so it has to be multiple of the 10% in terms of printing of currency. Okay. So foreign exchange securities and others. So this is how minimum reserve system creates monetary base. On the basis of monetary base, this is also known as high powered money, which is the foundation of money supply in the economy. I've already told you what is high powered money. High powered money is the amount of money which is issued by central bank, and different people say different names. Some countries they say base money, some say high powered money or reserve money. So this is the base level for money supply, and this is known as high powered money. It comprises of what? Reserve money comprises of what? Currency in circulation, coins and notes which we have or which is in the circulation, bankers deposits with RBI. So all other players who deposit with the bankers, they deposit with the RBI. That is one. Other deposits with RBI, excluding banks, others which they deposit financial institutions, non-financial institutions, NBFCs, foreign bodies, state governments, all those they deposit money with RBI. So that is the total money, which is known as reserve money. Reserve money is currency in circulation. Bankers deposit with RBI, banks they deposit with RBI, and other deposits with RBI. So this is the core of, please do keep it in mind, reserve money. It is also known as high powered money. Credit money I've already shared. What is credit money? Credit money is the money which is created by banks. So credit money is the total supply of money in the economy. It is also determined by the extent of credit created by commercial banks. How commercial banks create credit money? So I've already told you people, a customer A opens the bank account in, let's say, PNB and goes for putting 10,000 rupees. Now, out of these 10,000 rupees, there is another customer of PNB, which is Mr. B. That fellow goes to bank and says, I want to withdraw 5,000 rupees to pay to my client. So bank will give 5,000 rupees because that fellow is having a current account with the bank. So 5,000 rupees given to that B. B pays to C. C has a bank account in Canara Bank. So C deposits in Canara Bank. Now Canara Bank has 5,000 rupees. Out of that 5,000 rupees, if let's say that the bank has to keep minimum 10% of it. So after deducting 10% of it, bank can go for lending it to D, and D will go for paying interest to the bank. So this is how the money gets multiplied, and that is known as credit money, which is created by whom? This is created by commercial banks. Okay, so high powered money and the credit money, these two are the core components of money supply or the total stock of money in the country. So high powered money 1 and credit money 2. So these are the two components which creates money supply or the stock of money in the country. Now, money supply is measured by different countries, different central banks in a different manner. We have also evolved over a period of time in terms of measuring money supply. So how do we measure money supply? We in India, Reserve Bank of India publishes 4 alternative measures of money supply: M1, M2, M3 and M4. M1 is currency and demand deposits. M1 is currency and demand deposit. Demand deposits, I have already told you. What are demand deposits? Demand deposits are, you put your money in the bank account, in savings and current account. So this is known as CASA. CASA is current account and saving account, which is here in the terms of demand deposits, and this is currency. So currency with people in terms of cash, coins, notes, whatever it is about. So that is about M1. M2 is M1, that is this currency plus demand deposits plus saving deposits with post office saving banks. So when you go for putting your money in the post office saving bank account, that is known as M2. M3 is net time deposits of commercial. Net time deposits of commercial banks means what? Net time deposits of the commercial banks means that it is the amount of money which has been deposited by people. The money which is of government or of Reserve Bank or other banks, interbanks, that is not part of M3. So net time deposits is deposits of commercial banks excluding the interbank deposits. So when you exclude interbank deposits, that is known as net time deposit. Time deposits are time deposits for a specific period of time. In a layman terms, what we call it as FDs, fixed deposits. Okay. Then M3 is total deposit with post office saving organizations, which is excluding national savings certificate. So these are the four parameters or alternative ways through which money supply is measured. The most acceptable form of money is M3. M3 is what you see in the newspaper normally. They talk about money supply. So broad money and the narrow money, which we will be sharing in the next slide. So narrow money and broad money. What is narrow money? Narrow money is M1 and M2 is narrow money. What is M1 and M2? M1 is currency plus demand deposits and M2 is M1 plus saving deposits with post office saving banks. So these two are narrow money, and broad money is M3 and M4. So based on the liquidity, they decide about narrow money and broad money. So as you move from M1, M2 to M3 and M4, it becomes more liquid. More liquid means easy to transact. That is the liquidity. So M4 is least liquid of all and M1 is the most liquid. So currency you have, bank you can go easily. So liquidity goes on decreasing from M1 to M4. If you have currency, you can readily go and spend. If you have account in the bank, you can go and issue a check. Now you can do through net banking in a fraction of a second. You can go for any transactions. You can connect your bank account with your Beam app or UPI app, and you can make all payments at a faster pace. So this is about liquid. When you have in saving deposits with post office saving bank account, that is a little bit cumbersome to take out money. You have to fill out a number of documents and then go for taking. So liquidity goes on decreasing when you move from M1 to M4. So M1 is the most liquid and M4 is the least liquid in terms of transactions. So M1 and M2 are narrow and otherwise it is a broader money. Because M3 is most commonly used, I've already told you. So when you read in the newspaper, normally it is M3, which is quoted as money supply in the economy. Now, Reserve Bank of India has introduced new guidelines, or I would say they have made it more precise and extensive at the same time. So reserve money, what is reserve money? We have shared. Reserve money is the money which is with RBI. So reserve money is currency in circulation, which is issued by whom? By RBI only. Bankers deposit. Banks, they go for putting their money in with RBI. That is bankers deposit with RBI. Other deposits are state corporations. Then you have foreign institutions and other non-banking financial companies. All they put their money with RBI. That is known as other deposits with RBI. So the money, reserve money, which is there is currency in circulation, bankers deposit with RBI and other deposits with RBI. This can also be written in terms of net RBI credit to government. Government goes for giving credit to the government of India. RBI goes for giving credit to government of India because RBI is a custodian of government funds. So if government need funds, then in that case, RBI gives to government. RBI also gives to commercial banks for their liquidity, and when the demand in the market increases, credit demand in the market increases, so banks, they go for taking it from RBI. So RBI credit to the commercial banks also. RBI claims on banks also. So RBI can have some claims on banks where they have to take money from them. That is also part of reserve money of RBI. RBI has some forex reserves, forex assets, where RBI has invested in foreign exchange market. So they have foreign exchange assets. So these are net foreign assets. What they are liable to pay and what they have is the net foreign assets. So government, RBI having foreign exchange reserves or assets. Government currency liabilities to the public. What government is liable to pay to the public, that is also part of Reserve Bank of India. But all these are plus, and what RBI has to deduct from it is obviously its net non-monetary liabilities. So what RBI is liable to pay, all its non-liabilities, non-monetary liabilities have to be deducted. This is known as reserve money, the money which is with RBI and which is the basis of money supply in the economy. Okay, so you will have some questions, numericals based on this, that how to calculate reserve money, how to calculate M1, how to calculate M3. So if you have gone through past year question papers, you will find many questions based on this only. So they have given stats, numbers have been given, and they have asked you to find out what is reserve money, what is how much is M1 money, how much is M2, how much is M3. So you should know these components. Once you know these components, then it will be easy for you to calculate the reserve money or the value of M1, M2 and M3 respectively. So what is M1? M1 we have already shared, it is the currency with the public. Demand deposits with the banking system, you put your money in the banks, and other deposits with RBI. So that is M1. What is M2? M2 is M1 plus short-term deposits of residents, this which is less than 1 year time period. So short-term deposits in money market is less than 1 year, where you go for putting, that is M2. M3 is M2 plus long term. So you see, that is why we say broad money M3, because when M3 includes what? M3 includes everything. It includes short-term deposits. It includes long-term deposits. What is call and term funding for financial institutions? This term, this, if you can see, call public term funding. What is call and term funding? Actually, call money is, for example, if in the economy, let's say that credit demand goes up, people are optimistic about that economy is progressing, there will be demand in the market, so corporate starts producing more, they need more funds, so they go to the bank to take loans. So if the credit demand increases, then in that case banks should have more money. Suppose there are many customers who have come to PNB bank to take loan, and bank is not having that much quantum of money, so bank will approach PNB bank will approach Canara Bank. Can you lend me for a day? So if Canara Bank will lend money to PNB Bank for 1 day, then in that case, the rate at which Canara Bank will be charging from PNB is known as call rate. Okay, term rate is for 14 days and more than that. So if a bank borrows for a day, interbank borrowings, call and term is for interbank borrowings. Okay, so when interbanks, they go for borrowings based on the requirement of credit requirement. So higher the credit requirement in the market, higher will be the call and term money, term rate in the market. Okay, so I hope you understand the difference between reserve money, M1, M2 and M3. And why we say M3 is a broad money, because it comprises of currency with the public, demand deposits of ours with banking system, other deposits with Reserve Bank of India. It also includes short-term deposits, which is less than 1 year, and it also includes long-term deposits, plus it also includes call term funding from financial institutions. So this is how the money categories have been divided. too important to remember is that what is currency with the public? Currency with the public is, you will have some questions related to this also. Currency with the public is money which is there with households, firms and institutions, but it is excluding money which government and the banking system have. That is known as public currency. Currency with the public. Currency with the public is money which we have, which corporate have, and which other institutions are having, but it is excluding money which is there with government and the banking system. So that is the currency with the public. So I hope you differentiate between reserve money and public money. Yes, reserve money is the money which is available with Reserve Bank of India, which is reflected in Reserve Bank of India's books, and currency with the public is money which is with household, firms and institutions. So that is the difference between currency with the public and reserve money. So government and all state government, local bodies, banking system, all banks, that is the part of the that is excluded from the public money. So this is how public money and reserve money is different, and then M1 and M3 is different. So what is the difference between M1 and reserve money? It is very important for you to differentiate, because you will be calculating based on this difference only. All your answers will be correct. So what is the difference between M1 and reserve money? Bank reserves are the component of reserve money. Bank reserves, money which is with reserve. Commercial banks, which they cannot use it for lending, that is a part of reserve money. But that is not part of M1. M1 are not part of monetary base. So that is how you should differentiate. So the money which commercial banks have, which they cannot use it for lending, is a part of reserve money. That is not part of M1. The money which we put it in the bank as demand deposits, that money is available with the banks to lend. That is known as, that is a component of M1, but it is not part of reserve money. So that's the difference between the two. What is cash reserve ratio, CRR? CRR is the money, quantum of money, which is, so suppose let's say that bank is having 100 crores. If the bank is having 100 crore and RBI says that 4% has to be kept with Reserve Bank of India, which you cannot use. So 4% of 100 crores has to be kept with Reserve Bank of India. So how much money the bank can go for using it for lending? That will be 96. No, 96. 100 crore out of 100 crore, 4 crore has gone for CRR. So 96 crore is available with the bank to go for lending. So higher the reserve ratio, lower will be the CRR is the ratio according to which bank keep cash with it or with RBI. Bhumika, CRR is the ratio to which banks keep cash with Reserve Bank of India, which they cannot use it for lending, and they do not get any interest on that. So that is the reserve which they have to keep it as. SLR, statutory liquidity ratio, is the quantum of money or the ratio which banks can keep with themselves, but that also they cannot go for lending. So these are the reserve components which cannot be used by banks, and that decreases banks' lending capacity. And since it decreases banks' lending capacity, that means the credit creation by banks will be also less. Higher and higher reserves, lower and lower credit creation by banks. Now we know that new currency has been introduced now. Cryptocurrency was not acceptable by Reserve Bank of India, and we have seen what has happened to it. But across the world, countries, central banks are using, are rather introducing digital currency. This digital currency is issued by central bank. So this is a central bank digital currency, which is issued by central bank and which is a legal tender. And this is in a digital form. So this is how Reserve Bank of India is bringing ease of transaction for people through bringing digital currency, which has been introduced in India at a pilot level, but it is still to be launched for the retail segment of people on a larger scale. So what is total money supply? We have shared what we have shared till now. We have shared that why money supply is important. Who are the two players who create supply of money in India? How the money supply is measured through M1, M2, M3 and M4, which is most liquid form of measurement or the money component, and which is the most illiquid. What is the difference between broad money and narrow money? Then the next thing we have shared is that the concept of reserve money and public money. So reserve money is the money which is with Reserve Bank of India, and public money is the money which is available with the public. It's excluding the money which is with commercial banks and with the Reserve Bank of India. Okay, so who creates monetary base? Monetary base is created by Reserve Bank of India. What is the backing of monetary base? Monetary base is based on foreign exchange reserves and gold in the country. And who gives guarantee for it? The guarantee is given by Government of India. That is why it is also known as fiat money. Okay, so this is what we have shared. Now I told you all throughout from the very beginning that banks have the capacity to go for credit creation, which creates money in the economy. So how banks create money in the economy? Banks, they take care about three major portfolios. One is about loans. Once the bank goes for lending, they get interest. So you take a loan from the bank, you have to pay interest to the bank because bank is lending you, so you get interest. Other is that you put your money in the bank, bank has to give you interest, that is expenses for the bank. So assets for the banks are loans and investments. So banks, they go for generating interest by lending. Lending to corporate, lending to retail, to consumers like us. We take loan for cars, bike, fridge, and your mobile, whatnot. And corporate, they take loan for machines, equipments, to make payment, credit payments, and so on and so on. So those who take loan, they have to pay principal as well as interest to the bank. That's the source of income for the bank. But what is the capacity, or how the capacity of banks lending is decided on? So what is the factor which decides about how much a bank can lend? It depends on reserves. If RBI goes for saying that you have to keep more reserves, that means that much money is out of the bank in terms of lending, and the bank will be able to lend less. If the banks are able to lend less, they will be able to generate less money. So the credit creation in the market will be less if reserve rate goes up. Okay. So 1 rupee increase in the monetary base causes money supply to increase by more than 1 rupee. If we have already shared 1,000 rupees in PNB you deposit, it will create definitely more than 1,000 rupees for the bank. This is known as money multiplier. Money multiplier, how many times the money gets multiplied by putting money in the bank, is known as deposit multiplier. You deposit money in the bank, and how much additional money by all the banks in the country is generated is known as deposit multiplier. Money multiplier is how much money RBI has injected in the system and how much multiple amount of money supply has been generated. That is money multiplier. So money multiplier is a broader term and deposit multiplier is a narrow term. Okay. So money is the currency held by public or bank deposit. C stands for currency and D stands for demand deposits. I've already told you what is demand deposits. What is money multiplier? What you see on the left side is money supply. M, capital M is money supply, small m is money multiplier, and MB is monetary base. Okay. So how much money will be supplied in the economy depends on what? Money multiplier and monetary base. So monetary base is what? Monetary base is the quantum of money or the reserve money we have. Money supply is the total amount of money available in the economy, and how much multiple of monetary base is money supply, that is decided on money multiplier. So what exactly is money multiplier? We have seen the formula, but if you understand in a simple words, it is about if RBI goes for injecting 100 crores in the economy through banks. How RBI goes for injecting 100 crores in the banks? What RBI will do? RBI will go for purchasing bonds from the commercial banks. So RBI will purchase bonds from commercial banks, and since RBI is purchasing bonds, commercial banks will get money. So commercial banks will get money. How much? Let's say RBI has purchased bonds worth 100 crore. So since RBI has purchased bonds worth 100 crore, so commercial banks get how much quantum of money? Commercial banks get 100 crores of money. And since they get 100 crores of money, when they go for circulating in a credit market and they multiply that credit money, that generates 500 crore of money supply in the economy. So what will be the value of multiplier? 100 crore injected by Reserve Bank of India, and total money created by commercial banks is 500 crores. That means 5 times money has been generated. So the value of multiplier becomes 5. So if you know any one of the component out of these three, if you know about the total money supply, if you know monetary base, you can find out money multiplier. If you know money multiplier and you know monetary base, you can find out how much will be the money supply. So if money multiplier value is 5, monetary base was how much? 100 crores. So 5 into 100 will be 500 crores. So 500 crore will be the money supply. If you know money supply is 500 crore and monetary base is 100, so the value of multiplier will become 5. 500 by 100 will be 5. So if out of these three, if you know two components, two variables, you can find out the third one. Now, what is the basic assumption believed in the case of money multiplier? The two basic assumptions are that banks will never hold excess reserves. Excess reserves means RBI says that you have to keep out of 100 crore, you have to keep 4% aside. If banks keep only 4% aside, that means the banks are not going for excess reserves. But if banks go for keeping more than 4%, I'm sorry, if banks keep more than 4%, then what is happening here? Banks are going for creating excess reserves. So the basic assumption is that banks, they do not go for creating excess reserves. You understand the implications of excess reserves? If the bank is supposed to keep only 4% as reserve, and so 96 is available to go for lending. But if banks, they go for keeping 8% rather than keeping 4%. So why will banks keep more than what is required by RBI? They keep extra or excess reserves. Banks sometimes keep excess reserves. Then what RBI gives them guidelines regarding that you have to keep this much quantum of money as reserves. Reason being, banks, they feel that this the risk may go up and tomorrow people may go for taking more, withdrawing more money from the bank. Suppose people start withdrawing more money from the bank, then in that case, banks will be running short of funds. So to secure the risk, they go for keeping excess reserves. And what is the impact of excess reserve? Excess reserve leads to low lending. Low lending means less credit creation. Yes. And the other basic assumption, so if you want to see 100% impact of the money multiplier, these two basic assumptions are required. One, banks, they never go for excess reserves, and individuals and non-bank corporations, they do not keep currency. Because you see, if you keep cash, that means you're not depositing that money in the bank. If you are spending more cash, then in that case, what are you doing? You are withdrawing your deposits from the banks. So both ways bank is losing, no? One, because you are not depositing in the bank. Second, you are withdrawing money and that money is going to the market, which is not coming back to the bank in any form. So both ways bank is losing. So the two basic assumptions which are there assumed are to see the 100% impact of the multiplier. Number one, banks, they never hold excess reserves, because if banks are going to hold excess reserves, what is going to happen? Their lending capacity will reduce. Their lending capacity reduces means the credit creation in the market will be less, and credit creation is less, then in that case multiplier impact will be less. And if individuals and non-bank corporations, they go for keeping currency, cash more, then in that case individuals and corporate are not putting money in the bank. They are not putting money in the bank. Banks are not having enough liquidity. Since banks are not having enough liquidity, they cannot go for lending. They cannot go for lending. That means the further credit creation won't be there. So these are the two basic assumptions to justify that if multiplier is 500 crores will generate 500 crore. But you will see in real world, it may not happen. If 100 crore is invested or is injected by Reserve Bank of India and money multiplier value is 5, but in that case, it may be possible that 100% conversion is not there. So now we'll see what are the reasons. Why is it possible that there may be some factors which may not lead to 100% conversion or at par money multiplier with respect to deposit multiplier. So deposit multiplier should be higher and money multiplier will be less in that case. What determines the size of the money multiplier? Any questions if you have, you can ask in the meantime. Are you getting me or not? Anything you want to ask, you can ask. Okay, so money multiplier, how do we calculate money multiplier? Money multiplier is the reciprocal of the reserve ratio. Reserve ratio is what RBI tells commercial banks to keep aside. So if RBI says that reserve ratio is 5%, then in that case, what will be the money multiplier? Money multiplier in that case will be 5%, no? So 1 by 5%, that is 0.5. In this case, 0.05, sorry, 5. So what will be the value here? 0.05. So how much it will be? Money multiplier. How much will be the value of money multiplier? If it is 10%, then you'll go for 1 by 0.10. That will be the money multiplier. If the reserve is 10%. If reserve is 5%, then in that case, it will be 1 by 0.05. That comes to 100 and that comes to how much? 20. So money multiplier in this case is 20 when the reserve is 5%. When the reserve is 10%, then it is how much? 10. So money multiplier impact is less when reserve value is higher. Money multiplier is more when reserve value is less. That's the impact of multiplier. Good. So it's clear to you. Okay, good. So money multiplier concept is clear. Money multiplier is about 1 by reserves. 1 by reserves is money multiplier. What is this reserve? Reserve is the amount of money which commercial banks are not supposed to lend. They can't go for lending. So this money goes out here. No, this money goes out. That means the impact will be less. So higher and higher are lower and lower multiplier impact. That is why when inflation goes up, so what RBI will do? RBI will increase this. If RBI increases this, money supply in the economy will reduce and the impact will be less. Reverse will be true. During COVID, what happened? During COVID, this R was decreased to increase money supply in the economy, because that time people were not ready to spend money. So this is the impact. So what is your learning? Higher the reserve ratio, the less of each deposit banks loan out, and the smaller the money multiplier impact. So that's the learning from this. Okay. This, we had referred to Milton Friedman when we were talking prior also. So when we had spoken about money demand, if you remember. So Milton Friedman and Anna Squads had shared about money multiplier approach by taking three components. The three components are high powered money. We have already shared what is high powered money. How much money has been injected by Reserve Bank of India. That is high powered money. Second is ratio of reserves to deposits. Reserves to deposit means how much reserves banks have to keep with respect to the total deposit. If 100 crores deposit and the reserve has to be kept 10% of it, so that means the ratio of reserves to deposit or reserve ratio. So how much has to be kept aside? So that is reserve ratio. Other is ratio of currency to deposits. Ratio of currency to deposit, how much percentage of the deposit people want to keep it as cash. If people go for keeping more cash, then in that case, this money will be out of the market, out of the banks. So this is minus. More and more currency people keep, less and less deposit they'll put in the bank, less and less deposit they'll put in the bank, less and less banks can go for lending. Less and less banks can go for lending. That means less credit creation will be there. And the impact will be, money multiplier impact will be lower. So that's the impact of currency to deposit ratio. Higher and higher reserves, then in that case, same will happen. Lending will decrease, credit will decrease, and money multiplier impact will decrease. But if stock of high powered money goes up, then credit will increase, lending will increase, and in that case, money multiplier impact will be more. So what is the relationship here? Money supply determinants. Out of these three determinants of money supply, this is having a positive impact on money supply, this is having a negative impact on money supply, and this is also having a negative. Sorry, this is positive, this is negative, and this is negative. So these two will have higher and higher reserves, lower and lower money multiplier, higher and higher currency to deposit, lower and lower money multiplier, more and more high-powered money injected by Reserve Bank of India into commercial banks, higher is the money multiplier. Banks become rich, bank becomes rich means their lending capacity increases, credit demand increases, credit demand increases means it will lead to circulation of money and more credit creation, that will, credit multiplier will be there, okay? So see, this is whose behavior decides about high-powered money. It's a discretionary choice of Reserve Bank of India. So this is the behavior of whom? RBI. How much high-powered money to be there injected? So RBI decided during COVID, money should be injected more. Obviously, government had some role to play in that because government said that growth is hampered, people are suffering, and so on. So that is why people are not people are hesitant to spend. So go for injecting money. You have learned about, I believe, 2008 crisis. At that time, what happened? Money was injected. Money was injected means money supply increased. Who increased the money supply? Federal Bank increased the money supply. So high-powered money is normally increased in the case of low sentiments, downturn in the economy, to boost the sentiment of corporate, to bring economy back on track by investments and consumption demand. Then they go for injecting high-powered money. When they believe that there's too much of consumption, when the ease of credit is leading to high risk, then they go for absorbing money. So Reserve Bank of India's thought process, behavior decides about how much high-powered money to be injected in the economy, how much to be absorbed. So that's the behavior of central bank reflected through injection and absorption of high-powered money. Okay, what about commercial banks? Commercial banks, how much reserves do they keep with respect to deposits? As we have shared, sometimes the banks, they go for creating excess reserves. So if banks goes for creating excess reserves, what's going to happen if you create excess reserves? So you are supposed to keep only 10% of reserves and you keep 20%. What's going to happen? Here you had 90 crores to disburse and now you're having only 80 crores to disburse. So if you go for excess reserves, if a commercial bank goes for excess reserves, then in that case, they will be lending less, credit creation will be less. I hope it is clear to you people. So that is whose behavior is deciding this, commercial banks. Okay. In the case of currency to deposit ratio is decided by whom? By people like me and you. If you believe that you need more cash to spend, you have more obligations to go for paying for your some payments are due, you believe that cash is more helpful rather than depositing money in the bank, so you go for keeping more currency in cash than you put deposit in the bank. What will happen? If you keep more cash, you do not put money in the bank, bank will have less money. Bank is having less money, that means bank's lending capacity will decrease. Bank's lending capacity decreases means credit creation will decrease. Credit creation decreases means money multiplier impact will be less because the money supply in the economy will be less. Okay, so these are three factors which were highlighted by Milton Friedman and Anna Swartz for making people understand that money supply may be not only dependent on how much money has been injected by Reserve Bank of India, but it also depends on how commercial banks are behaving. What do they think about the market? What is their perception about the risk? How much reserves they are keeping aside? Are they going for excess reserves? Thinking about that in future they have to maintain more reserves, so that is why from today only they are maintaining high reserves. If they go for maintaining excess reserves, then in that case deposits growth will be adversely affected. At the same time, if currency people want to keep more cash, people are more willing to go for cash, people start withdrawing more money, then in that case banks become less liquid. Banks becomes less liquid, their creation capacity, credit creation capacity reduces, and money supply in the economy reduces. So what are the three behaviors which may bring less impact of the multiplier? One is that commercial bank behavior, which has a direct impact. Because you see, reserve money is the basis, no? And which is created by whom? By RBI. So if reserve money decreases or the high powered money decreases, all subcomponents of money will decrease. But if the factors like commercial banks behave in a different manner, people behave in a different manner, then in that case, high powered money may not make that much impact. So this is what is the essence of this particular theory. Okay. I've already shared high-powered money and the money multiplier vary directly. More and more money injected by Reserve Bank of India, more and more monetary base is created, which helps to create more credit. But it is inversely related to currency and reserve ratio. Currency is by whom? By public, and reserve ratio is by commercial banks. So that's the inverse relationship between credit, money multiplier in the economy. Okay. So although you see these three variables do not completely explain changes in the nominal money supply, but to some extent they help you a lot to find out that why it happens that despite easy money, high-powered money injected in the system, still the money supply is not increasing. What are the factors which are leading to less increase in money supply than expected? So it may be because of the banks behavior, it may be because of the behavior of people, those who want to keep more cash, or banks, they want to go for excess reserves. So this is clear to all of you. I've already shared excess reserve. What is excess reserve? Excess reserve is that banks have been told that you have to keep total reserves of 800 billion. If the total reserves are 800 billion, banks have been told only 600 billion to be kept as reserves. So banks were told to keep only 600 billions, but they have kept 800 billion. So excess reserves kept by the bank is 200 billion. This money is out of the bank because 200 billion they have kept excess. So this, despite the additional high-powered money that goes, so the high-powered money injected by Reserve Bank of India, out of that 200 billion is out. This is out. So this excess reserve do not lead to creation of money. Therefore, if the central bank injects money into the banking system, and if commercial banks keep it as excess reserves, then in that case, it will not have any effect on deposits and no effect on the money supply. Okay, so that's this question was there in one of your papers. What is the impact of excess reserves? So you can explain with the example, and this is how you can explain. First, you have to explain what is reserves, what is the impact of reserves. You have to explain what high-powered money leads to, and then talk about reserves, and then talk about excess reserves, and talk about the money creation in the economy, how it gets hampered because of that. Now, we have already shared time deposit and demand deposit. So in the banks, if you go for more FD, if the bank is having more FDs, fixed deposit, then demand deposit money. So let's say bank is having 100 crores of time deposits and 80 crores of demand deposits. Now time deposit 100 crores means, time deposit means the bank is having more time, no? More time because you are not going to take money before that time normally. Some people may withdraw before that, but whole lot of people will not withdraw money before that time. So bank have enough time to deploy that money or to give money to other people. So more and more time deposit banks are having, more and more banks can generate money supply in the economy. Yes? Because money, that is why you see banks, they offer longer the period of term you go for taking fixed deposit, higher is the interest rate. Because if you go for longer term putting money in the bank, then in that case, bank is having more time. Bank is having more time to lend money, and banks lend money to multiple people. And since the bank can lend to multiple people, it will create multiple cycle of credit creation. Multiple cycle of credit creation means multiple income or the money supply will be generated in the economy. So that's the impact. So it is good for the banking industry if they have time deposits more than the demand deposits, because it helps in more free reserves, and these free reserves helps in enlargement of the volume of money expansion in the economy. Yes. Any questions if you have, you can ask. Any doubts if you have? Anything not clear, you can ask. Otherwise, I'm taking it for granted that you have, I'm assuming that you're clear with all things. Only Bhumika is responding. What about others? Anyone else? Okay, so the money multiplier basically is a function of what? It is a function of three components as we have shared by Milton Friedman. First is about what? Currency ratio by depositors. This is represented by C. That is behavior of the public. Second is excess reserve. That is represented by E. Excess reserves by commercial banks. Currency ratio by depositors. That is C, by people like me and you. And the reserve ratio set by central bank. That is R. These are the three parameters Milton Friedman had shared. C is for currency, by whom? By public. E is excess reserve, by whom? By commercial banks. R is reserves by central bank. Okay, so these are the three components which decides about money multiplier. So money multiplier is a function of currency ratio with respect to deposits, excess reserves, and this is about reserve ratio given by RBI. So we have shared that the money supply in the economy is currency plus demand deposits, total currency plus demand deposits, and high powered money is currency plus reserves. How much reserves are there and currency. So currency and deposits are assumed to be demand deposits. D is the demand deposits and this is the currency I've already shared with you. You understand this. C is currency deposit ratio. R is reserve ratio, reserves to deposit ratio, and E is about excess reserves. Okay. So this is money supply. Money supply, which can be calculated here. This M is money supply. This C you know is currency deposit ratio. This R you know is reserves as per the Reserve Bank of India. And this H is high powered money. High powered money is issued by whom? By Reserve Bank of India. This M is a money multiplier. So this is the money multiplier equation. 1 plus currency deposit ratio, reserve ratio to deposit ratio, and currency deposit ratio. If we add commercial, so this is a behavior of whom? This is a behavior of reserve is a behavior of whom? By RBI. This is the behavior of RBI. This is the behavior of public, people like me and you, and this is the behavior of commercial banks. Yes, so this is money multiplier when you take all the three variables. So you can calculate the value of money multiplier if you have been given these three components, or sometimes you have to calculate also. So there are some numericals based on this asked in the past in your question paper. So if you look at this is the question which was there. Nominal money supply. Nominal money supply is this money supply. Let's say that you remember we had shared in demand for money. PY is nominal money supply. PY basically price into money. If we say that the total amount of money generated is 100 crores and the price level in the economy is, let's say, 5%, 5. So the total nominal money is 500 crores. But this increase is because of the price level. So price level, when the price level increases, nominal money supply increases. But if you keep this price as constant, then we call it as real money supply. Real money supply means taking prices as constant. That is real money supply. Now, this question was there in one of your papers. Define money multiplier. So you know how to define money multiplier. Money multiplier, we have discussed how do you define money multiplier. Money multiplier we have shared is equal to 1 plus C upon 1 plus R E plus C. This is how we have done it. We have done it R E plus C. This is money multiplier. Deposit multiplier is, how do you calculate deposit multiplier? Credit multiplier 1 upon R is deposit multiplier or the credit multiplier. Yes, this is how we have done. Look at this. We have done this now. Money multiplier here. And money multiplier you can also calculate. We have done this also, money multiplier calculations. This is money multiplier. Money multiplier is also money supply upon monetary base. And money supply is determined on three components. So money supply is determined on three components. We have taken a monetary base. H is monetary base. The question is, define money multiplier. Use of e-wallets is increasing at fast pace nowadays. how this enhanced use of e-wallets is affecting money multiplier and money supply. What can you say about this e-wallets? So what's happening because of e-wallets? How many of you are using Paytm? You are using Google Pay. You are using your Bheem app. What do you do? What do you do? You top up money, no? You top up money in that regular basis because you want to buy things. So what are you doing? And how the money is routed? The money is routed through your bank account. So you go to a retail outlet, you want to pay, you can pay directly. You may not carry cash, but it is becoming more easy for you to transact. So what's happening now? More and more credit creation is happening, no? So you put more money in your account, you go for spending more and more. So the money multiplier impact is higher. Because are you keeping cash? Because of e-wallets? No. You're depositing more, you're depositing more. So we have taken component C. So what's happening to this C? The C currency you're keeping less. If you're keeping currency less, that means you're depositing more. You're depositing more means you're creating more money supply. Money supply increases because the money multiplier impact will be more. So this is how it is helping. That's why banks today, they want to keep more money. And that's what banks are promoting. No, government is promoting, banks are promoting e-wallets because you realize you're spending more today. Why you're spending more today? Because it's very easy. Just you scan your mobile through your mobile and the payment is done. Prior, what you used to happen? You used to carry cash. You used to go to a place and you used to think, oh God, if I'm not having change, let me forgo about it. But now what's happening? It's a matter of fraction of second. You can make payments. So e-wallet is resulting in what? Is resulting in more transactions. More transactions means more money supply. More money supply means that is higher the value of money multiplier. So this is 3-mark question. You have to explain currency deposit ratio. You have to explain the behavior of public, and you have to explain the impact on banks and this impact on multiplier. So you can share this equation. You can talk about currency deposit ratio. You can talk behavior of people. You can talk about how technology has brought change in the people behavior, their behavior to keep less cash and going for more transactions. How is it helping banks? Banks, they're getting more cash rich, and because of this, it is becoming easy for them because the chances of default are also less. So that is creating more money supply and having a higher money multiplier impact on the economy. Is it clear? How the cash reserve ratio plays role? What is the role of cash reserve ratio? Though we will be sharing it later, but this is a component of what cash reserve ratio is. High powered money. So high powered money, if high powered money, RBI says that you have to keep more money, then in that case, if banks, they go for keeping extra reserves. So excess reserves. If banks go for excess reserves, then in that case, the lending capacity will decrease, the credit impact will decrease, money multiplier impact will decrease, and money supply in the economy will reduce. It depends on bank behavior, cash reserve ratio. Yes. So banks behavior decides about. So the first question is about public behavior. Second is about bank behavior in terms of reserves. Because cash reserve ratio is one is about, rather you should take care about both Reserve Bank of India behavior and as well as commercial banks behavior also. So you will talk about both the behaviors here. And in the first question, you'll talk about what exactly is money multiplier. So you'll say money multiplier is money supply by money power or the money base, monetary base. That is money multiplier. And then you'll talk about extended definition of money multiplier, Milton Friedman, which comprises of 3 components. And in this case, the major component is currency deposit ratio. And this currency deposit ratio, you can further explain by how e-wallets have made it easy. And that's why it leads to higher money multiplier and money supply in the economy. I hope it is clear to all of you. And what is credit creation process? Credit creation process, basically we have shared. See what basically happens. If RBI wants to, I have shared already during COVID time, RBI wanted to increase, wanted to make people, persuade people to go for more spending, more investments. But people were hesitant because the sentiments were very low. So people were hesitant. So what RBI did, RBI had to stimulate economic activity. What it did, it infused liquidity. Infused liquidity, how it infused liquidity? It pumped money into the system. How it pumped money in the system? Through open market operations. What are open market operations? Open market operations are buying and selling of bonds by central bank. OMO is buying and selling of bonds. To whom bonds are sold? If bonds are sold to commercial banks, so commercial banks, if it is sold to commercial banks will pay. If commercial banks will pay, that means commercial banks will become less liquid, less rich. So banks become less liquid means banks go for lending less. And that case, less money creation. Yes. So money creation will be less. That is the impact of high powered money. So what is happening here? RBI is taking money from the market, taking out money by selling bonds. When RBI goes for buying bonds, so RBI buys bonds from commercial banks. So if it is buying, then RBI is paying to commercial banks. So commercial banks get paid, that means they become more liquid. They become more liquid, that means their lending capacity goes up. They go for more credit creation. And credit multiplier will increase. Money supply in the economy will increase. That is how the money supply in the economy, credit creation process happens. Okay. So this is how it works. So money supply is 1 upon reserves. If RBI wants to go for reducing money supply, then in that case, the reserves will increase. If RBI wants to promote money supply, then reserves will decrease. So this is how it works, credit creation process. And we have already shared how it works. This fellow A goes for putting money in the bank, 100 rupees or 1000 rupees or whatever it is in the bank. So this bank gets 1000 rupees. Now this customer B comes, he's depositing and he's taking and has to pay to the bank certain rate of interest, at certain rate of interest. So bank will get money, plus the fellow has to give the money back also. And this fellow goes for giving it money to C. And C has a bank account in other bank. So the money goes to this bank. And this bank also goes for lending it to D. And D has account in other bank. And this goes on. And this is how the money gets created. Multiplier impact. Okay. So credit creation process. This has been explained here in your module. You can see that I have just taken a like snapshot of it, but I'll simply share. I've already shared 900 rupees because 100 rupees, 1000 rupees, let's say 10% is reserves. So 10% reserve gone. And they go for issuing check and so and so. And the sequence keeps on going. The sequence keeps on continuing until the initial deposit amount grows exactly by the multiple of the reserve required 10%. So the expanded credit availability will be 1000 initially, then 900 because 10% gone. So 90% of 1000, then 90% of 900, and so on. They go for lending. So 729 lended, then 719 lended, and so on. And when you sum it up, that comes to, because 10% is reserve, so reserve 10% is 1 upon, we have shared, multiplier is 1 upon reserves, that is 1 by 0.10. This comes to how much? I'm sorry. This comes to how much? 100. Sorry, 10. So if you have 1000 rupees, if the bank is having 1000 rupees initially deposited, and the multiplier value is 10, so this will become 10,000 creation of money in the economy. So that is how 10,000 is created. Okay, so this is how. So lower and lower reserves requirement, more and more money creation. If this would have been 5, then this would have become 20. And if this becomes 20, that means 20 here. Rather than 10,000, it would have been a 20,000 figure. So this is the impact of reserves on the money multiplier. Okay. So the credit multiplier is the reciprocal we have already shared. So this is credit multiplier in the economy. This is also known as deposit multiplier. Deposit multiplier and credit multiplier is same. Credit multiplier is the reciprocal of the required reserves ratio. If it is 20%, that comes to 1 by point, that is 5. And the impact is, this is the credit multiplier. Okay, so this is the impact. So if it is 20%, then the credit multiplier value will be 5. And if the bank gets 1000 rupees, it will be 1000 into 5 credit multiplier. This is also known as deposit multiplier. So if you can see here, this is given in your book. If the credit multiplier is required reserve ratio, who decides about this required reserve ratio is decided by RBI. It's decided by RBI, which banks have to follow. So if the required reserve ratio is 10%, the credit multiplier will be 10. If the required ratio is 12.5%, the credit multiplier will be 8. And respectively, the value can be calculated. So initial amount is how much? Amount is 100,000. So if the required deposit, if the reserve ratio is 10, so 10 into 10, 100,000, that comes to 100,000. If it is 12.5, then it comes to 8. So 8 into 100,000, that comes to 800,000. So this is how this credit multiplier is calculated. Is it clear? Credit multiplier is clear to all of you how it is done, how the money gets multiplied, and what we had shared initially, that there are two ways money supply increases in the economy. One is injected by Reserve Bank of India through high-powered money. Other is through credit multiplier. But the credit multiplier impact depends on what? It not only depends on high-powered money, it also depends on how people perceive. They want to keep more cash, they want to keep more deposits. And the third component is how banks they perceive, banks' behavior. If banks believe that we should go for keeping more reserves, then in that case, the credit multiplier impact will be less. So this is what is about credit multiplier. So this was the question which was there in one of your papers, which says, what will be the total money credit created by commercial banking system for initial deposit of 500? So how much is the initial deposit? 500. If the required reserve ratio is 0.04, 0.06, and 0.10% respectively. So you'll respectively calculate. You will calculate the multiplier value for 0.04. So that will be what? 1 by point. This will be 1 by 0.04 is equal to M1. M2 will be, I'm sorry for my handwriting, 0.06, and third will be, sorry, M3 will be 1 upon 0.10. You calculate whatever value you get here, you multiply that with 500, you will get the credit multiplier value for 1, 2, and 3. Okay, so they're simply asking you credit multiplier value. Done. Next question is compute credit multiplier if the required reserve ratio is 10% and 12.5% for every 100,000 deposited. I believe this is same as given in your book. So this is the same, isn't it? 10% and 12.5% for every 1,000 deposited in the bank. What would be the total credit money created by the banking system? So here 10 into 10. In this case, I believe 8 into 10. This 100,000, and respectively you will get the credit money in the system. Is it possible that the value of money multiplier becomes 0? Yes, it can become 0. Money multiplier value can become 0 if the bank goes for decreasing the monetary base in such a manner that the money is available at a 0 price. At a 0 price, then the money multiplier becomes 0 in that case. So the deposit multiplier and the money multiplier, though closely related, are money multiplier and deposit multiplier interchangeable? You can interchange these two. Money multiplier and deposit multiplier, can you interchange? Or are they going to give you the same result? Deposit multiplier and money multiplier? Definitely not. Reason being, we have shared that deposit multiplier is what? Deposit multiplier we have shared with respect to how much? 1 by R. No, 1 by R is deposit multiplier. 1 by R means what is the reserve which we have to keep as per RBI guidelines. 1 by R gives you deposit multiplier, the credit multiplier. But money multiplier has components of not only high powered money, but it also has excess reserve component. It also has currency deposit ratio. So these three components also make impact. So how banks they behave, how people like us behave, that is going to make difference. So that is why it is possible that the deposit multiplier value may be higher, but the money multiplier value will be less. This is a 2-mark question. So you can write with respect to that. So first you write what is the difference between deposit multiplier and money multiplier. Then you can quote one example to explain that if people start behaving in terms of more keeping more currency and bank starts going for more excess reserves, then in that case the deposit multiplier and the money multiplier value will not be same. They seem to be very closely related. This can only happen if we follow those two assumptions, that banks do not go for excess reserves and people do not go for keeping any cash. Then in that case, deposit multiplier and money multiplier can be same, otherwise it will not be same. Yes, it is clear? So money creation is not the same as wealth creation. Creating money through credit by banks does not mean creating wealth. So banks, they create multiple cycles of credit, but that is not wealth creation. Yes, so it is simply money creation. So shall we take break and then we start again for this questions which are there in your question papers? So let's take break of 10 minutes and then we'll discuss about questions from your question papers in the past which were there. I hope for money demand you have taken care about questions which were there in your last year question papers. There were questions related to liquidity preference. There were questions related to precautionary motives. There were questions related to quantitative theory of money, which we have done. MB is equal to PT. So these were the questions which were there for last class in your question papers. Now we will be sharing after break all the questions, numericals related to this chapter. You want to ask any question, you can ask before I take break. Any questions, whatever we have shared till now? Any doubts if you have? Anyone didn't get anything? If you want to ask anything. Okay then. If you have any doubts, you can ask. Otherwise, I'll take questions. Anyone want to ask anything? If not clear, any of the sections what we have covered? Okay, I'm assuming from my side that all things what we have shared is clear to all of you. So the question here, you can see we have shared that money can be measured through M1, M2, M3 and M4. So this question states about calculate M1. Now the components given to you here are currency with the public. That means money what we have as public, demand deposits with banking system, that is the money with the banks. Demand deposits you already know about are checkable deposits. Time deposits with banking system, other deposits with RBI, and saving deposits of post office saving banks. So we have shared M1 comprises of what? M1 comprises of currency with the public, demand deposit with banking system, and other deposits with RBI. So we take only three things here to calculate M1. That is currency with public, demand deposits with the banking system, and other deposits with RBI. So these are the three components. So if you add this 9,000, then you go for adding this. Sorry. So if you go for adding deposits and the sum of 57,000 crores, this is M1. Now this was the question given in one of your papers. They are asking for narrow money. We have shared narrow money and broad money. Broad money is M3. Narrow money is in M1 and M2. So they are asking for M1. Now the question is currency with public, demand deposit with banks, other deposits with RBI. So you know what are the three components. This is a 3-mark question and you can straightway calculate. Good. So here you can calculate with respect to 2,80,000, 4 lakh, that is for demand deposit banks, and other deposits of 5,80,000. So if you sum it up, that gives you the narrow money. And please do keep it in mind whenever you're doing any solution of such kind of question, always write every parameter. Do not simply write the values. You will lose marks because this is not maths paper. This is economics paper, isn't it? So you have to write first that M1 narrow money is about, which comprises of currency with public plus demand deposit with banks plus other deposits with RBI. And then in the second equation, you write the values. And third, you get the answer and then conclude your answer by writing that the narrow money value is equal to so and so in crores. Do not rupees crores. So do not miss unit, do not miss the variables to be mentioned before you go for calculating the final answer. Because of your silly mistakes, out of 3, you may get 1.5 only because of these errors. So do not do such errors, okay? So money, M1 is narrow money. Then currency with public. We had shared currency with public means it is the money which is excluding of banks, isn't it? So public money is household and corporate, but it is not money which is of banks or RBI. So what we'll do, we'll take notes in circulation, we'll take circulation of rupee coins, we'll take circulation of small coins, and we will deduct what? We'll deduct cash on hand with banks because this is the money with the bank which is not part of public. So currency with the public, you will get it by taking notes in circulation, circulation of rupee coins, circulation of small coins, and you will deduct cash on hand with banks. So this will give you the value which will be in crores, and put commas, not like this, the way it has been mentioned here. So do not write like this. Always mention with commas and with units. And here you write all the variables before you write this. Okay, so this is how currency with public. Is it clear? Concept is clear. Currency with the public. Currency with the public will not have component of banks and RBI. Now this is about M2. For M2, what you have to do? M1 plus post office saving. So M1, you know, note and circulations will be included in M1. This will be included. Yes, this will be included. Circulation of rupee coins will be included. Small coins will be included. Post office saving bank deposit will be included. This is component of M2. So this has to be included. Cash on hand with banks will be included. No, this will be deducted because this is with banks. Deposit money of the public. Yes, this will be included because this is a part of it. So if you sum it up, deposit money of the public will include demand deposits with the banks. So if you sum it up together, you will get the value of M2. Yes. Good. So this is M1 and M2. You can calculate M2. Now here they are asking currency with the public and reserve money. So currency with the public, you know about currency with the public. Notes in circulation will be included. Circulation of rupee coin will be included. Circulation of small coins will be included. Cash on hand with banks will be included. No, it has to be deducted because this is the part which is with the banks. And when we talk about public, we do not include this. So this all will be the part of public money, currency with the public. What about reserve money? Reserve money is the money which is with RBI. So that is bankers deposit with RBI, other deposits with RBI, and this is about cash on hand with banks and time deposit with the banks. So the total money amount which is with the RBI is the reserve money. So reserve money will be included here. Next question is about reserve. This is about money multiplier. So we have already shared. If the font size is okay, I believe so. You can see this. This is from your notebook. This from your module only. If the reserve ratio is 10%, okay. Currency in circulation is 400 billion. Demand deposits are 1000 billion. Excess reserve is 1 billion. Find the value of money multiplier. We have shared money multiplier. How can you represent money multiplier? Money multiplier is 1 plus C upon C plus E plus R, isn't it? So these are the components which you have to add. C is what? Currency deposit ratio. E is excess reserves. R is reserves. So here R is given to you. R is reserve 10%. So it will become 0.1. Currency is given 400 billion and deposit is given 1000 billion. So 400 by 1000 billion, that comes to 0.4. So you will get 0.4 here for currency deposit ratio. This C you will get by 400 by 1000 billion. Yes. Excess reserves. How will you get excess reserve? Excess reserve is, they're saying excess reserve is 1 billion. 1 billion by deposit is how much? 1000 billion. So 1 by 1000 billion is 0.0001. So this is what? Excess reserve. This is the value of E. R is 0.10. C is 0.4 and E is 0.001. Now you substitute here in the formula, you will get the value of 2.79. What does this signifies? 2.79. It signifies if monetary base in the economy increases by 1 unit, then in that case, the total amount of money supply in the economy will be 2.79 units. So if money supply increases by 1 unit, the total increase, money base in the economy increases by 1 unit, the total increase or the increase rate of change in the money supply will be how much? By 2.79. This is known as money multiplier, and this is the formula. And for this, what you need to do, you have to calculate credit deposit ratio that is C. You have to calculate excess reserves by deposits. This will give you E. Then you have to calculate, you have to have reserves, which is given by whom? By RBI. So you get C, you get E, you get R. This is the behavior of public, this is the behavior of bank, and this is the behavior of central bank. Add up these three and you will get the answer divided by, so the formula is this one. This is the formula of money multiplier. You'll get the answer. Yes? Is it clear to all of you? Okay, so this is the question which has been given to you. So we have done this, the same question, which is their currency with the public and reserve money. So you can find out reserve money. How much will be the reserve money here in this case? Can you find out reserve money value? Are you calculating or not? Are you calculating or not? So you can calculate here currency with the public and reserve money. You will get the value. We have shared the formula of reserve money, yes. What is ways and means in advance facilities? Where are you, Bhumika? We're talking about excess reserves. You're talking about excess reserves. You're talking about what ways and means with respect to open market operations. Which page you're referring to? Are you referring to your module? So in this case, you can calculate the monetary authority in terms of M1 and M2. I've already told you the formula of M1 and M2. If you'll calculate, it will be easy for you because I have already told you how to go for calculating or differentiating between M1 and M2. So can you calculate here M1 and M2 and reserves? This is money multiplier. Again, the same concept what we had shared, that calculating money multiplier with respect to reserve ratio, currency deposit ratio is given to you, excess reserve is given. But what's the catch over here? The catch is they have given 3.44 you're talking about. Yes, exactly what happens, Bhumika, that see, it's a game of credit. Okay, credit is the factor which is dependent on what sentiments, how the economy is, sentiments are positive, so the credit demand will be there. Now, sometimes it happens that the credit demand increases because people are highly optimistic. So corporate, they start asking for higher quantum of loans. Then people start going for loans. And in this case, the banks are in need of shortage of funds, are in shortage of funds. They need money. What are the options banks have? Banks can go for raising money through the market. How do the banks they raise money? They raise it through certificate of deposits. That's long term. But the shortest route to raise money is through Reserve Bank of India. Now, raising money through Reserve Bank of India, one is through the repo rate and the reverse repo rate. Other is that over and above, if they need money, then in that case, RBI goes for lending, overdraft facility to the banks, that you are running short of funds and we'll lend you over and above so that you can meet the contingencies. And this is how RBI facilitates the process of financial transaction for banks in the case of contingency, which is known as ways and means and advance facility. So this can be given by RBI to commercial banks for excess reserves. If commercial banks wants excess reserves, that is how it works. Okay, so this is how banks, when they are in need of money, they can get it from RBI through liquidity adjustment facility, which is LAF, ways and means through which RBI goes for lending it to commercial banks to ease financial transactions and ease the credit flow in the market. That's how overdraft facilities they go for offering. Okay. So government, they go for creating a salary account. So RBI has to give money to government, because government has employees, government authorities, government organizations. They have to make them salary and others. So that is how RBI goes for lending it to. And these salary accounts are in commercial banks. So RBI goes for lending money to lend it to for this purpose for the commercial banks, so that the commercial banks can go for giving those salaries on behalf of Government of India to the employees. So suppose if somebody is working in NTPC and the NTPC bank account is in Canara Bank. So Canara Bank is a public bank account, and so RBI will go for giving money on behalf of government to the Canara Bank to be given to NTPC employees. Similarly for Air India when it was not privatized at that time, and so on and so on. Okay. So this is how extra reserves is created to increase the money supply and meet the money multiplier process and create more credit demand in the market. So this is about calculating money multiplier. I hope you know this here, calculating money multiplier with the help of reserve ratios being given to you. They have given you currency. So you can calculate currency deposit ratio. CD you can calculate here. This R is given to you. This will give you C. And for excess reserve, they have given you in million. You have to get it in billion to calculate this, and then you substitute here. You substitute here and get the answer. As simple as that. Okay, so this is how it is done. Can you do it yourself? Will you be able to do this yourself? So this is another question which is of 3 marks. What I've seen majorly in this unit, in this particular chapter, till now the questions are related to M1, M2, M3, money multiplier, credit multiplier. So these are the questions which are given, and less of theory has been given. More numericals have been given so that you can straightway score marks here. Only thing you need to be very clear with respect to what is currency with the public, what is reserves, reserve money, what is M1, M2, M3, how it varies, and respectively calculating and scoring full marks in this. So it won't be a problem for you if you are thorough with basics that how M1 differs from M2, how M3, and respectively you calculate and it will help you. So here they are asking for M2. M2 supply of money, currency with the public, deposits, saving deposit, net time deposits with the banking system, and demand deposits with banks. So what all you will take in this? M2 is saving deposits with the post office, currency with the public, and other deposits with RBI. Demand deposit with banks. So this will give you what? This will give you M2, because M2 is M1 plus saving deposits with post office banks. Now this is the question of 2 marks. It says, what is the impact of the following on credit multiplier money supply if commercial banks keep less reserve and excess reserve? So how will you answer this question? Credit multiplier and money supply, less reserve. So credit multiplier formula is, what is the credit multiplier formula? Credit multiplier formula or the deposit multiplier formula is 1 upon R. This is the deposit multiplier or the credit multiplier formula. 1 upon R. 1 upon R means if you keep less reserves. If you keep less reserves, then in that case, what's going to happen? If you keep less reserves, credit multiplier value will be higher. And money supply will be more because of this. And if you keep excess reserves, then in that case, the credit multiplier value will decrease and the money supply in the economy will decrease. You can give one example to explain. We have already shared, if you go for less reserves, your lending capacity increases. Banks can lend more. Banks can lend more. They can go for creating more credit. And the significance of credit multiplier, you explain with respect to bank behavior, and you can justify this answer by saying that in the case of less reserves, multiplier impact will be less, money supply will be obviously less, and excess reserves, greater. And in excess reserves, money supply will be less and the credit multiplier impact will also be less. So in this case, it will be less, and in the other case, it will be higher. Here they're asking you to calculate M3. So how will you calculate M3 in this case? This question is again 3 marks. Currency with the public, demand deposits with the banks. Then you have what? Other deposits with RBI will be included in this. So if you add these, you will get what? Demand deposits with banks. This will give you what? This will give you the value of M3 also includes time deposits, no? So you will get time deposits also included in this. Time deposits. So if you include these, you get the value of M3, which is a broader money. This is the question which is given, which is about reserve money. Reserve money is the money which is with Reserve Bank of India. So what are, which is reflected in RBI books. So we have shared, this is net credit, net RBI credit to the government. What Bhumika was asking about ways and means. Then RBI credit to the commercial sector, RBI claims on banks. It's all plus in the books of the RBI. Government currency liabilities to the public. Then RBI net foreign assets. And this will be minus, obviously net non-monetary liabilities will be minus. So you add these all and deduct this. This will give you the value of reserve money. So you get reserve money like this by adding these and deducting this. So this is how reserve money value can be calculated. Okay, so this is how it works. Any questions? If you have, I can take it. What we have shared till now. Any doubts? If you have, you can ask. Now, I would like you people to refer to this for reserve money. Questions on reserve money, you can refer to this, which talks about what? Currency in circulation, bankers deposit with RBI and other deposits with RBI. So this is the reserve money, which includes circulation, money in circulation, bankers deposit with RBI and other deposits with RBI. Or it can also be calculated through net RBI credit to government, which was last question which we had seen. In the last question, it was the components given were these. No, net RBI credit to government, RBI credit to the commercial sector, and so. So you may be given any of the components, and then you have to calculate reserve money. In major questions which we have seen, they have given the first only. Currency in circulation, bankers deposit with RBI and other deposits with RBI. But in the last question, what we saw were major parameters given were of the second component, which we see here, net RBI credit to the government and so on. And M1, you can see here, it is about currency with the public, demand deposits with the banking system, and other deposits. So this is what you have to remember to solve problems based on this the concept. So I've already shared the major parameters for you to calculate. And if you want to ask any specific question, you can ask. Otherwise, I'll revise with you people what we have done till now. This chapter, what from your module, if I want to tell you what all you need to be thorough with. So you can refer to these important things for your exam perspective. 3.34, which talks about 4 parameters of measuring money supply in the economy, that is M1, M2, M3 and M4. How we measure, because major questions are based on this M1, M2 and M3 and M4. Then you should know very well what is reserve money. You should be able to differentiate currency with the public with respect to reserve money. What is the difference between M1 and reserve money? That is also very important to understand. Then you should understand this significance of money multiplier, that how money multiplier plays important role in the economy, and how money multiplier and credit multiplier, they differ from each other. The value may be same, in which case you can get the same value, and what are the factors which brings change in the value of money multiplier and credit multiplier, and what are the 2 basic assumptions which are assumed in money multiplier to have the maximum impact. Is it possible that money multiplier is ineffective? Yes, it can be ineffective in the case where monetary base, if RBI goes for injecting money and it is not leading to increase in the money supply, then in that case, money multiplier value will be 0, because people are so pessimistic. That is what happened during COVID. That is what happened during 2008 crisis. People were not ready to spend despite injecting money into the system through high-powered money. Banks were hesitant about taking in risk, and at the same time, consumers were hesitant about taking loans and going for consumption. So that can be a problem in terms of money multiplier impact, when despite injecting money by Reserve Bank of India, things may not work because economy is very pessimistic, and in that case, the superimposing factors are commercial banks' behavior and public behavior. So 3.38 talks about the behavior of central bank, behavior of commercial banks, and excess reserves. And the question given in your paper is related to credit creation plus e-wallets. They can also ask you now about this CBDC, that is digital currency, how this digital currency is going to make impact on money supply and money multiplier, because people will be transacting more through digital currency, and what impact it will make on reserves and otherwise. So you should know about that also. Then they have given some numericals in your book related to this money multiplier concept by using currency, deposit ratio, reserves, and excess reserves. And then the concept has been explained with respect to government expenditure on money supply. If government goes for spending more, how it makes impact on RBI balance sheet. Because RBI is a custodian of Government of India. So government spending, government need of spending has to be met by whom? Has to be met by Reserve Bank of India. And this may impact on, and even now, if you know about, if Reserve Bank of India has gained some capital gain, that also has to be transferred to Government of India. So this is how it works, because they are representative of Government of India. Then the example given in your book is about COVID time. COVID time, what happened? Banks were risk averse. What do you mean by risk averse bankers? Risk averse bankers means banks were hesitant to lend because they thought during COVID, despite RBI had decreased the reserve requirement and money was injected through open market operations, also easy money was available to banks, but still banks were not ready to lend. Why the banks were not lending? So banks' behavior was not to lend and keep excess reserves. So banks were not lending because they thought that the customers who are going to borrow, maybe the corporate or maybe others, they may default, and banks were hesitant to lend. So the average deposit funds in the banks were increasing, but at the same time, the banks were not lending. So this created a gap between the money injected by Reserve Bank of India and money supply in the market, because banks were reluctant. At the same time, people were not ready to buy. So that is the reason this COVID case has been highlighted here. You should be able to connect very well, I hope so, with respect to this. The same context is applicable in the case of 2008 crisis. The same context is available today in developed countries today. They are going through the tough time, and the same concept is also applicable in Japan over the period of time. They offered almost zero interest rate, but still people are not borrowing because there's deflation in the economy. People do not want to spend on goods and services. So this is what is the concept, and there are some numericals which are given here related to M2 and M1 and M3, which we have already shared. Anything else you want to ask, you can ask. Any query if you have. I'm through from my side. I've already shared time demand deposits and the excess reserve or excess balances of commercial banks, which Bhumika had asked about ways and means of advance facilities. Any questions if you have, you can ask me. Otherwise, I'll just recap once more. Any other question if you have? So currency with the public is clear. Okay, so I'll revise once before we wind up. So we started with money supply. This chapter is about concept of money supply, where we had shared about that why money supply is important, because money supply depicts about country's health, how country's performing. If country is in good health, the money supply gets absorbed and the country is going to prosper. But if there is a problem in terms of high inflation, currency of the country is depreciating, business policies are not helping corporate to drive towards investments, consumers are not ready to spend, and in that case, money supply measures by Reserve Bank of India through high-powered money will be different. In the case of COVID time, it was totally different. So how money supply to be controlled is normally taken care by Reserve Bank of India through high-powered money, which is reflected in reserves of Reserve Bank of India books. That is known as reserve money also. So rationale of money supply is to create money supply in the economy for boosting economy or to control economy in the case of very high rate of inflation, or when the money demand is leading at a higher pace and to meet with the money supply. The most important concept is minimum reserve system, where RBI is supposed to keep minimum reserves, that is why the currency is known as fiat currency, because it is backed by Government of India, guaranteed by Government of India, and it is supported by forex and gold reserves. But it's not like that the quantum of gold reserve and forex reserve should be equal to the currency issued, because the other factor which leads to increase in money supply in the economy is because of the banks. So what do? They create credit money in the economy. So high powered money, what is high powered money? Is currency in circulation, deposits with RBI. What is other deposits with RBI? Other deposits with RBI includes bankers deposit, you understand? Banks, they go for depositing with RBI, and other deposits with RBI means deposits by non-banking financial companies, state corporations, then you have other financial bodies from international market. So all those are other deposits with RBI. And credit money is the another form of creating money supply in the economy. High powered money and credit money are the two components of money supply. Money supply can be measured through M1, M2, M3 and M4. As you move from M1 to M4, the liquidity decreases and the broadness of the definition increases. That's why M1 and M2 are considered as narrow money and M3 and M4 are considered as broad money, because normally the money supply in the economy, what you see is measured through M3, which comprises of currency plus demand deposits. Demand deposits also comprises of CASA, that is current account and saving account, and net time deposits of commercial banks. Net time deposits are deposits which are of the public, not of the interbank. So interbank deposits are not included in it. And this we've already shared. Then this is very important to remember. Reserve money. Reserve money is currency in circulation. Banks deposit with RBI and other deposits with RBI. And M1 is currency with public, demand deposits with the banking system and other deposits with RBI. Otherwise, M2 includes, modified definition also includes short-term time deposits of residents, which will be less than 1 year. Currency with the public excludes money which is with the government and the banking system. So that is excluded, that money is excluded. The difference between M1 and reserve money. M1 is about money which is inclusive of deposits with the banks, but reserve money is not including the M1 is not including reserve money, which is with Reserve Bank of India, and it is not including reserve money is not including bank deposits. So that's the difference between the two. CBDC is the new currency which has been introduced. This currency is a digital currency. It has been introduced between the banks and to some level on a pilot study basis. Still, it is yet to be adopted fully in India. The total supply of money in the economy is currency plus demand deposits. That is with the public. So public demand deposits, or the bank deposits, currency with the public, and demand deposits. This is money. Money multiplier is money supply divided by monetary base. Monetary base is the high powered money. Money multiplier is the change in the money supply because of the money monetary base. This depends on reserves. And two basic assumptions we go for: that banks never hold excess reserves and individuals and non-bank corporations never hold currency. But normally in real practice, this is not true, and that is why the value between the credit multiplier and the money multiplier varies. So money multiplier is 1 by R. This is money multiplier. And Milton Friedman had given 3 parameters, or the 3 determinants of money supply. One is the stock of high powered money. Stock of high powered money increases and money supply increases. Ratio of reserves to deposits increases, money supply decreases. Ratio of currency to deposit increases, money supply decreases. So all these 3 variables are not the complete exclusively defines about money supply. There can be some other components also, but these are major components which makes impact on the money supply. Nominal money supply is the variables are the approximate determinants of nominal money. So what you see is nominal money supply, because higher the money supply in the economy, lower will be the impact on the price level in the economy. So money supply increases, the price level in the economy will be moderate. What is excess reserves? We already shared. The benchmark reserves, which are defined by RBI, that is normally covered in terms of CRR and SLR, which we'll be sharing later. So these two components decide about how much reserves to be kept. If banks, they go for keeping over and above, that means the bank's lending capacity decreases and the money supply in the economy will reduce. Time deposit, if banks have more time deposits, that means the money supply in the economy will increase because their deposit expansion capacity will increase. This we've already shared. Currency deposit. This is money supply and high powered money we have shared. This is money multiplier, important formula we have shared. And I've discussed with you people, e-wallets and others, credit creation process, how open market operations they operate by central banks, and how credit creation takes place. So this is what is there in this chapter. Any query of yours, I'll take it. Otherwise, I'm through. If you have any query, you can ask. Okay, less reserves, more credit, supply money, less reserves, credit. 846, okay, good. Demand deposit mostly used by general public, not by business organizations, because they need funds in crores, amount in crores is not easily available. Am I correct? See, demand deposits basically, Bhumika, when we go for demand deposits are, we say both ways, current account and saving account. That is why we are using the term CASA. Current account, normally banks, they do not offer interest on that. That's why you're saying no, they go for big sum of money. So this is how they go for solve one question which is in billion and million. Okay, so billion, if you want to convert billion to million, that is 800 now. I believe 800 was there. So 800 will be 0.8, no? If you go for converting it to million. So basically, question, which is the question? Where is it? It's given. Yeah, this one. So in this question, what you have to do, this is given. Who is this? Sudhanshu. Sudhanshu, this is given in your module also. I'll tell you the page number where they have given this. This is basically you convert into 0.8. Convert it into 0.8. Excess reserve to 0.8. Million to billion. If you convert this million to billion, this is 0.8. So you take this excess reserves as 0.8. Okay. And this currency deposit ratio is 200 by 400. Okay. So do it by 200 by 400. And this is given 0.10. So this C becomes how much? 200 by 400 is 0.5. E becomes 0.8. 0.8. And deposit is 400. So divide 0.8 by 400. That comes to how much? Divide 0.8 by 400. 0.8 by 400. This will come to, okay, let me calculate. You can also calculate simultaneously. So you take it as 0.8 divided by deposits. Deposit is 400. That comes to 0.002. So E becomes 0.002. Okay. So this is M. This M is equal to 1. C is 200 by 400. That comes to 1 by 2. That is 0.5. 800 million becomes equal to 0.8 billion. Okay, this to be divided by 400 because we are calculating every figure has to be divided by deposit, no? So this will give you E. So this is coming how much? 0.002. So this E comes to 0.0. This 200 by 400 is 0.5. Yes, so 200 by C is 0.5. C is 0.5. And this is how much? 0.10. R is 0.10. Now you substitute. So this becomes equal to M is equal to 1 plus 0.5 upon 0.5 plus E is 0.002 plus R is 0.10. Now you calculate M, you will get. Okay. Done, don't you? So now you calculate what's the value coming for this. How much is it coming? Do I calculate? Okay, good. Okay. No queries? Good. So I hope it is clear to all of you. So I'll take leave for the day and we are going to meet. We are going to discuss in the next class monetary policy. Very, very important topic, monetary policy. In the meantime, you can revise these two chapters, money demand and money supply. Okay. Okay, Bhumika. So it is coming 1.6629. That means by 1 unit increase in monetary base, the total increase in money supply in the economy is by 1.66. So this is happening. You see the gap is here because of the factors, behavior of we the people in terms of currency deposit ratio, then the excess reserve ratio. So these factors are leading to 1.66. Otherwise, this would have been how much? 1 by R. 1 by R is 10. So that would have been 10. But now it is less because of the factors which are affecting here. Okay then, take care.